Hello everyone, welcome back to another video. If you're new to this channel, my name is Farhan and I help POA students like you ace their exams. Today we have got a practice question which requires you to understand the difference between capital expenditure and revenue expenditure. You will also learn to calculate the accumulated depreciation for a non-current asset which we have sold and also calculate any profit or loss we have made during the sale of this non-current asset. You can see the question on the left hand side of your screen, and on the right hand side we have all the workings which I'll explain and go through step by step. What I need you to do now is focus and follow through the entire content for an excellent understanding. With that being said, let's begin. Jonathan has a business whose financial year ends on 30 September. The business incurred the following expenditure for the year ended 30 September 2016. So here we are given four different types of expenditures that have taken place during the year ended 30 September 2016. And our job is to classify these expenditures between capital and revenue expenditures. Before we could do that, let's first understand the difference between capital expenditure and revenue expenditure. Capital expenditure is when we buy a non-current asset or when we add value to an existing non-current asset. When we add value to an existing non-current asset, this could be, for instance, renovations which you do to a property which increases the property value. All right. Also, capital expenditures are what we classify as non-current assets and are reported in the statement of financial position, also known as the balance sheet. Then you have got the revenue expenditure. The revenue expenditure refers to the day-to-day operational expenditure for the business. Simply saying it's just expenses which we report in the income statement. This could be, for instance, insurance expense, petrol expense, maintenance expenses, revenue expenses, utilities expenses, basically anything that helps the business run its daily operations. Okay? Now let's classify each of those four expenditures that you can see in the question between capital and revenue expenditures, starting with the first one, which is the purchase of delivery van. The purchase of delivery van refers to the purchase of a non-current asset, which is what we will be reporting in the balance sheet, and therefore this is classified as a capital expenditure. All right. Next, we have got the petrol for delivery van. The petrol for delivery van allows us to make sure the van runs, and this is a part of the day-to-day operational expenses for the business and is therefore classified as a revenue expenditure. Okay. Next, we have got the replacement of tire. Replacement of tire, just think about your tire that is already worn out or has gone bad. And now you need to change it because without changing it, you are unable to actually operate the vehicle for the purpose of generating revenue for the business. Therefore, this is also part of your operational expenses because it makes sure the business is operating based on this expenditure that you will make. Therefore, replacement of tire is also classified as a revenue expenditure. Next, we have got the annual insurance premium, which simply stands for the insurance expense. This is also a revenue expenditure because insurance expense is basically out there to protect the business from any theft or any damages that may occur during a typical financial year. An insurance expense basically acts as a safeguard in the event something goes wrong. You could just contact the insurance company and get your things sorted, right? So therefore, this is what we classify as revenue expenditure because this is not, again, a purchase of a non-current asset, nor we're adding value to an existing non-current asset. And therefore, it doesn't fall within the definition of a capital expenditure, but only falls within the definition of a revenue expenditure, okay? All right. Now let's look into the second part of the question where you will calculate the accumulated depreciation and also find the profit or loss and disposal of a non-current asset. Okay, so I'll just bring this question up. So let me just change the settings so that you can easily access it. All right. Okay, so here we have got the question. So on 30 September 2016, the business sold a piece of equipment and received a check of $12,700. This equipment was bought on 11 April 2014 for $28,000. Equipment is charged at 20% per annum using the reducing balance method. A full year's depreciation is charged in the year of purchase and the year of sale. We are required to calculate the accumulated depreciation of the equipment sold and also find out any profit or loss that we have made on the sale of this non-current asset. Okay. All right. Now, let's have your attention to the right-hand side where we have got all the workings. First of all, we understand that we are working with a business where the financial year typically starts in 1 October of any given year and ends on the 30th of September of the next year or the following year. Okay? Now, the asset that we're talking about here, which is this piece of equipment, was originally purchased on the 11th of April 2014. So year one for this asset will be from 11th of April 2014 until the end of 30 September 2014 when the business would have ended its financial year. Now, based on the business policy, we are to apply a full depreciation in the year of purchase. And a full depreciation is calculated by simply multiplying the given percentage with the original cost. The given percentage, as mentioned in the question, is 20%, and the original cost is $28,000, which is what you can see in the second line here. All right, $28,000. And altogether, that gives us a full depreciation of $5,600 in the first year. Now, anytime you're using the reducing balance method, I recommend you also find out the net book value at the end of the financial year. So the net book value at end of 30 September 2014, or the net book value at any given point in time, is simply calculated as the difference between the cost and the accumulated depreciation. The accumulated depreciation stands for the total depreciation which we have so far since the day of purchase. Now, the cost, as we already know, is $28,000, and the accumulated depreciation is the depreciation expense which we have derived for the first year, and that is $5,600. Therefore, 28,000 minus 5,600 gives us $22,400 as the net book value at the end of the first year or at end of 30 September 2014. Okay? Now, we will move to the second year. Now, second year will start on 1 October 2014, which is when the financial year of the business typically starts, and it will end on 30 September 2015. In this second year, we will calculate the depreciation by simply multiplying the given percentage with the net book value. And this is what we do when we are working with a reducing balance depreciation method question. Okay, so the given percentage, as we already know, it's 20%, and the net book value which we derive at the end of the first year is 22,400. That gives us a depreciation in the second year of 4,480. Again, we want to find the net book value at the end of year two, which is at end of 30 September 2015. And in this time, the net book value can simply be calculated by taking the net book value which we already had at the end of the first year, that is 22,400 if you recall, minus the additional depreciation expense which we have derived for year two, 4,480. That way, the original formula of net book value calculated as the difference between the cost and the accumulated depreciation is already factored in. Okay, that gives us a net book value at 30 September 2015 to be $17,920. Okay, next we move to year three, which is the last financial year for this question. Year three would start on 1 October 2015 and end on 30 September 2016. And in year three, based on the requirements mentioned in the question, we are to apply a full depreciation as well. The question clearly mentions that a full depreciation is to be applied in the year of purchase and also in the year of sale. Regardless of whatever is happening, we also know that year three would start on 1 October 2015 and end on 30 September 2016. And on 30 September 2016, we actually ended selling up this machine, so which makes sense to actually depreciate it in full. So the full depreciation is calculated by multiplying the given percentage with the net book value. The given percentage is 20%, and the net book value which we had at end of year two was 17,920, which forms the basis of this calculation, and that gives us a full depreciation of 3,584 at end of year three. Now, we want to find the net book value at end of year three, which is at end of 30 September 2016. This is again pretty straightforward. You take the net book value that we had at end of year two, which is 17,920. That amount already factored in all the depreciation from previous years, minus an additional 3,584 for the depreciation expense which we have derived for year 3. That gives us a net book value of 14,336. at 30 September 2016. Okay. Now, the question wanted us to find the accumulated depreciation of the equipment sold. This can be done pretty straightforward, where if you want to find the accumulated depreciation, you can just add the individual depreciation expenses which we have calculated for each of the 3 years. In year one, we got 5,600 plus an additional 4,480 in year two, plus an additional 3,584 from year three. Altogether, this tree can be added together to give us 13,664 as the accumulated depreciation for each of the 3 years of usage for this asset. Okay. Now, this already answers the question which we are required to answer for part C. Now, in part D, we are required to find out any profit or loss that we have made on the disposal or sale of this non-current asset. Now, we know that we ended up selling this asset for $12,700, which is what we refer to as the disposal proceeds, the amount that you have received by selling this asset. And during during the sale of this asset, the net book value that we had left was $14,336. The net book value refers to the economic benefit that is still available within this non-current asset for the purpose of helping a business generate more revenue, right? So you understand the asset had more value within itself than what we ended up selling it for. The value we had was 14,336, but we ended up selling it for less at $12,700. What does that tell us? That tells us that we have sold this asset for a loss, and the amount of loss we have made is simply calculated as the difference between the net book value of 14,336 and the disposal proceeds of 12,700, which gives us an amount of $1,636, which is the loss that we have made by selling this asset. Okay. All right, so that's all for this question. If you found value in this content, make sure to drop a like and subscribe to this channel. And you can check the link in the description to book a free Zoom call with me and discuss your online coaching requirements or tutoring requirements to help you prepare for your exams at the end of year. So with that being said, I'll conclude today's lesson and I'll see you in the next one.